Let's start things off with Bank of America's fund manager survey for July, showing optimism on Wall Street is at an all-time low. With recession anticipation the highest it's been since May of 2020, expectations for global growth profits are at all-time lows. Additionally, the BofA bull-bear indicator, that remains max bearish right now. And there we're taking a look at one of the core charts that was a part of this broader survey from BofA. But they said high inflation is now seen as the biggest tail risk, followed by a global recession and hawkish central banks and systemic credit events.
I mean, there's definitely some eye-popping stuff from this, right? I love the title, I'm so bearish, I'm bullish. Because usually when you get these extreme indications of sentiment, it can be a bullish indicator, right? That you get a snapback effect. That do we finally have, you've probably heard us talking about before, viewers out there, capitulation, right? When there is an exhaustion of selling, maybe stuff is finally priced in and things can start to build again. It's unclear for at that point, but maybe. The first bullet point here is the full capitulation, a dire level of investor pessimism, cash levels the highest since 9/11, equity allocation lowest since Lehman. I mean, this is some extreme stuff here, and that chart shows how extreme as well. Profit optimism in an all-time low. So what that figure shows is the net percentage that say global profits will improve from here. And obviously that is a very, very small percentage of those surveyed.
Yeah, I know we have a few of the other charts that we were continuing to take a look at as well. One of them was really later on in the survey. It talked about discretionary versus staples, where consumers are really, and not just consumers, but also investors are placing some of their own kind of defensive measures at this point in time within the market. And so it was really interesting to see where some of the most crowded trades were as well at this point in time.
Yeah, you're right that people were getting more defensive, right? So, and when they talk about defensive in this survey, they're talking about the sort of traditionally defensive sectors, places like utilities and healthcare, for example, where people getting more long and not as long in the so-called cyclical areas that tend to be more economically sensitive. All of this makes sense.
Sure.
If you're expecting a recession, those areas traditionally would not necessarily do well. So, obviously, the pessimism is at an extraordinarily high level out there. The question, as always, is now what, right? Have we gotten to a place where some of this or all of this is priced in? When is there going to be a recession, if there is going to be a recession, and is that priced in? What is the effect going to be on corporate profits, and is that priced in? And we're starting definitely to hear a lot of companies that are coming out with more negative forecasts that seem to reflect more and more of this pessimism.
And even though we're just at the beginning, the starting line of this particular earnings season, with some of the companies that have started to at least give us not just how they performed in this most recent quarter, where many of the banks that we were looking at as well, they had already lowered some of their expectations for this most recent quarter. So lowered expectations for the prior quarter, and then a forecast that for a company in J&J that we'll dive into in a little bit. We'll see if companies continue to maintain the guidance that they've already put out there, if they start to lower that guidance, or if they pull guidance altogether. And that could be an even more bearish indicator within the broader earnings season that we're looking at.
That was a lot of what we were seeing during the pandemic. You referenced the most crowded trades portion of this, which definitely caught my eye. This is the perception of where these fund managers see the most crowded trades. The most crowded one is the long U.S. dollar trade at 41%, long oil and commodities. And the dark line that you're seeing here is the most current, the darker blue. The lighter blue is from June. So you've really seen a jump in dollar versus long oil commodities, which was the longest one back then. And indeed, we have seen this incredible rally in the U.S. dollar that, as you and I have talked a lot about, has been having an effect on companies. We've also, in addition to the dollar index, which is versus a basket of currencies, we've been watching the euro trade in particular. Some reporting this morning from Reuters that the European Central Bank, which is set to meet this Thursday, is considering raising interest rates by 50 basis points, which is larger than expected. So that's something maybe that's causing a little bit of a tick up in the euro this morning. But once we then get the Fed raising rates next week, maybe we'll see that go back to what we have been seeing, which is dollar strength.
Just to briefly add on to that, within this survey as well, among equity regions, investors most bearish on the Eurozone right now and Japan as well.